Hello everybody, welcome back to my channel. Our today's topic is taxation of dividend income. Finance Act 2020 shifted the tax liability on dividend income from the hands of the dividend declaring company to the individual investors. Today we are going to discuss about taxation of dividend income from Indian companies and mutual funds. If you are new to my channel, I request you to subscribe and hit the bell icon below so that you can get notified when I post new videos. After the abolition of the dividend distribution tax, the taxability of dividend income is now in the hands of the investor. Now we will discuss the old and new tax provisions related to dividend income and its tax implication. The dividend received from an Indian company and mutual fund was exempt up till 31st March 2020, that is financial year 1920. That was because the company declaring such a dividend already paid dividend distribution tax before making the payment. However, the Finance Act 2020 changed the method of dividend taxation. Henceforth, all dividend received on or after 1st April 2020 is taxable in the hands of the investor or shareholder. The dividend distribution tax liability on companies and mutual funds stands withdrawn. Similarly, Section 115 BBDA, that is the tax of 10% on dividend receipt of individuals, HUF and firm in excess of rupees 10 lakh also stands withdrawn. If you own shares in an Indian company or have units in a mutual fund and you receive dividends in your bank account, you must report this income while filing your ITR under the head income from other sources. This is because dividend income is now taxed as per the slab rate applicable to individual. If your income puts you in a higher tax bracket, you may have to pay a large amount of tax on the money you receive from such investments. Now we will discuss about TDS on dividend income. The Finance Act 2020 also imposes a TDS on dividend distribution by companies and mutual funds on or after 1st April 2020. The normal rate of TDS is 10% on dividend income paid in excess of rupees 5,000 from a company or mutual fund. It is important to note that this threshold of rupees 5,000 is considered for each distributing company separately, not in aggregate for the total dividends received from multiple companies. For example, if there are two companies, company A and company B, and company A pays a dividend of rupees 4,000 and company B pays a dividend of rupees 10,000. In that case, company A will not deduct TDS as the amount is less than the threshold of rupees 5,000. But the company B will have to deduct TDS as the dividend paid is exceeding the threshold of rupees 5,000. The tax deducted will be available as credit from the total tax liability of the taxpayer while filing ITR. For non-resident persons, TDS is required to be deducted at a rate of 20%, subject to the double taxation avoidance agreement if any. To avail the benefit of lower deduction due to the beneficial treaty rate with the country of the residence, the non-resident has to submit documentary proof such as Form 10F, Declaration of Beneficial Ownership, Certificate of Tax Residency, etc. In the absence of submission of these documents, higher TDS would be deducted, which can be claimed at the time of filing ITR. If TDS was deducted from your dividend payments, then the company or mutual fund house will issue you Form 16A. This form also contains details like amount of TDS, amount of payment made by such deductor, etc. The deductor issues this form quarterly within 15 days of the due date of furnishing its TDS return. Now we will discuss as to what all expenses are allowed as a deduction from dividend income. The Finance Act 2020 also provides for deduction of interest expense incurred against the dividend. The deduction should not exceed 20% of the dividend income received. For instance, if a person borrowed money to invest in equity shares then the interest on borrowed amount will be allowed as a deduction. However, you are not entitled to claim a deduction for any other expenditure like commission or salary expense incurred for earning the dividend income. A resident individual receiving dividends whose estimated annual income is below the exemption limit can submit Form 15G to the company or mutual fund paying the dividend.
Senior citizen.
Whose estimated annual tax payable is nil can submit Form 15H to the company paying the dividend. The company or mutual fund informs the shareholders about the dividend declaration on their registered email ID and request for submission of Form 15G or 15H to claim dividend income without TDS. Advanced tax provisions apply if the total tax liability of the taxpayer is equal to or more than rupees 10,000 in a particular financial year. Interest and penalties levied in case of non-payment or short payment of the advanced tax liability. I hope this video provides you with the clarity regarding taxation of dividends received from an Indian company and mutual fund. If you have any queries relating to this video, please let me know in the comments below. If you found this video interesting, like, share the video and subscribe to my channel. Thank you for watching the video. I will see you all in the next video.